There have been some pretty big shakeups recently concerning stablecoins and cryptocurrencies, and headlines like this will help you understand why. This is coming from payments.com, and it says how US stablecoin regulation could change the game for global payments. A draft bill to establish a framework for stablecoins in the US was announced, and the global payments ecosystem may be reshaped. Welcome to the AlterNate Vantage. My name is Nate. This is where I provide a different perspective on finances, news, and generational wealth. If you like this kind of content, then don't forget to like and subscribe. All right, back to the video. Okay, so I want to pick out a couple key details that this article highlights and which I think are probably the most important facets. First, they state businesses hate slow and expensive international payments. Makes sense, especially if we're talking about trillions of dollars. Stablecoins, digital assets tied to real-world money, like the US dollar, potentially promise to change that, as evidenced by Stripe's $1 billion acquisition of stablecoin infrastructure platform Bridge. They say stablecoins aren't the future. They're already transforming how people move money today, said Zach Abrams, who's the co-founder of Bridge. Coming from Stripe, they say, we believe stablecoins will play a critical role in turbocharging cross-border commerce. If you haven't, or if you have been paying attention to my channel for any number of time, I've been talking about pretty routinely that every single time you mention, they have the mentioning of cross-border payments, cross-border commerce, cross-border functionality. They're talking about one of two things: stablecoins or central bank digital currencies. What's important to understand is that stablecoins are indeed another form of currency, and they're trying to make the justification that just transferring some, US dollars as an example and putting them behind a digital representation of those same fiat currencies provides some sort of, value, which in case it doesn't, you're moving from a fiat currency into a digital currency. There's nothing behind the fiat currency besides paper. There's nothing behind the digital currency besides code. The only difference is your presumed buying power. Because anytime you hear the words slow and expensive, means it's slow and it's costly, right? It costs money to use these other, call it even prehistoric systems, which some of them are pretty old school. So when you introduce things like stablecoins, what's actually being communicated is that you are going to have more perceived buying power when you use these digital forms of currency because it's faster and it's less expensive. That's very important to note because things like Gersham's Law comes into play when we're talking about bad money replacing good money. Not to say that US dollars were ever good to begin with. I'm just saying that stablecoins are far worse. Let's continue down this article. Now, they go on to mention that in order for stablecoins to work, they will need a proper regulatory framework. Well, it just so happens that on February 6th, the House Financial Services Committee chairman introduced a discussion draft for a bill that would establish a framework for issuing and operating dollar-denominated payment stablecoins. Now, what's really taking place here is just opening up the conversation, right? Just because the House is proposing a bill, there's so many different steps that have to take place before we see anything come to fruition out of that bill. But the conversation doors are open. And even with the conversation opening, we see many different institutions and agencies already pressing down the gas pedal in terms of getting their technology prepared for the introduction of stablecoins. I've talked about Visa in the past. Now, Visa's already launched their tokenization services. I've talked about JP Morgan and Chase with their Project Connexes, how they already have the established framework to introduce stablecoins. They already even have the JPM coin. There's already big organizations like Citibank, which is essentially the bank behind the Treasury. They already have their Citicoin for their institutional depositors. There's many different things taking place right now, in which case all these large institutions already have the infrastructure in place to adopt new things like stablecoins, for example, like this bill is proposing, or at least the regulatory framework behind them. They're already doing all of their beta tests. And in videos in the past, I've talked about the influence of the Bank of International Settlements and their half a dozen projects that they have concerning central bank digital currencies, which in actuality is just another form of stablecoins, if you want to look at it that way, just issued by the central bank. But when you're talking about stablecoins, the whole concept is that it's diversified, whereas not all of the coins are being issued from one centralized location. But even all that being said, the controlling entity or authority behind these stablecoins remains the same because it's all being undergirded by US dollars or US Treasuries, and this article kind of highlights that. Now, moving on a little bit, and before I get there. So they said the largest financial institutions are eager to explore tokenized assets. This is Nicola Plekis, I don't know, head of commercialization, Visa Crypto, and I just talked about them for a little bit. The proposed bill comes as stablecoins are being increasingly heralded as the bridge between traditional finance and the cryptocurrency world. In other words, they are a means of transition and have started to change that dynamic. And here we go, talking about how they're undergirded from enhancing transaction efficiency to driving demand for US Treasuries. The potential benefits of strong stablecoin innovation are immense. They are trying to recapture, to re-identify, to recapitalize even the benefit of holding US Treasury bonds, holding US dollars, and how those things could change under a US stablecoin system. And then last but not least, if you like to understand jurisdiction and power plays and power struggles in the political realm, then this might mean something to you. But they go on to say, so whereas the Clarity for Payment Stablecoins Act of 2023 proposed oversight by the Federal Reserve, the Stable Act designates the Office of the Comptroller of the Currency as the primary supervisor for federally qualified non-bank stablecoin issuers. Here's the key difference. The OCC falls under the authority of the US Treasury, which has direct influence by the Office of the President and Congress. This would be a huge shift of power from the Federal Reserve, which right now functionally controls the value of our dollar, whether or not they have high or low interest rates, and whether or not they are printing massive amounts of dollars, and of course using those dollars to buy US debt. So what does all this mean to you? I have a repeating theme in my videos that I really like to drive home, and that is Gresham's Law. Bad money replaces good money. If the perception, if the idea, if the concept is that you are going to have more buying power when you change over to a stable coin as an example, then that's going to encourage a lot of people to ditch their US dollars and get stable coins, right? They're trying to assess that these are, stable USD, whatever you want to call them, essentially digital currencies that are backed by US dollars. But here's the thing. If that was to take place, you technically have two forms of currency being used. Regular fiat currency, and then you have stable coins. And so if people are moving from regular fiat currency and moving those positions into stable coins, the value of that fiat currency is going to get lower and lower and lower and lower and lower. Meaning you might see our price tags move higher, but that just means our purchasing power has become lower. What does this mean for everyone else? Well, that means you need to take advantage of your buying power that you have today. This is why it's important to understand the time value of money. A dollar you have today is more valuable than a dollar you could have tomorrow. And you can thank our inflationary system for that, but the inflation is going to get much worse before it gets better. So right now, you need to be capitalizing on the buying power of a dollar and putting that into assets. If you have no means of getting cash flowing assets like real estate or acquiring businesses that have reputable, time-tested goods and services that they can exchange for value, then you can get yourself into simple forms of assets like whole life insurance, or even simpler forms of assets like gold and silver, which retain their value through transitionary periods. But please don't get this wrong. We are going through a monetary transition right now. Everything in the financial space is changing. If you don't believe me, just look at what's happening in ISO 20022. Do your own research on that front. But if you want to continue to stay up to date with things that are taking place in the markets and how they impact you, then don't forget to like and subscribe, follow the channel, leave a comment if you learned something, and with that, I will catch you in the next one.